Welcome back on how to hedge against inflation. In this video, we're going to go over commodities. So the first thing we're going to go over is what are commodities? Commodities are raw material, normally things that come from the earth. We're talking about metals, oil, gas. Other commodities would be coffee, orange juice, beef, wheat. If you remember in trading places, they were doing pork barrel bellies, they were doing orange futures, they were talking about commodity prices. They were betting on the future price of commodities. So with commodities, they are base level items. Everything relies on their price and they will ripple through to everything else we're buying. Side note, the depth of the financial structuring of trading places is one of the best I've seen in any business movie.
We are commodities brokers, William. Commodities are agricultural products like wheat, which is used to make bread, pork bellies, which is used to make bacon, which you might find in a bacon and lettuce and tomato sandwich.
Like the level of understanding you have to do pork belly futures, orange futures, the move that they pulled is beyond any of the other movies that I've seen in the business space. And it was hilarious. So very, very good movie. So the next common question that would be asked is, how does commodities hedge against inflation? So if we look at money, the basis of money, it's an exchange. And we look at the base items, which are commodities. Again, coffee, oil, milk, meat, wheat. Those items are base level items. We can't live without food. We can't stay warm without natural gas, and we can't build much without these metals. So these base items have a very tight connection with the inflation rate. So the exchange of dollars you're giving up and this commodity is going to be very tight. So these are the Venezuelan bolivars. Roughly one $50 bolivar is going to buy you a sheet of toilet paper. And the reason is because the government kept printing more money. So as the government fabricates inflation, creates inflation, it's dropping the purchasing power. So if we had this much money in the system, and now we have this much money in the system, we doubled it. Because of this exchange, this trade of something that's been doubled, the commodities dealer will actually require double the money. This is a very simple example, but roughly that's how it works. The reason the cost of materials, the raw materials, have gone up is not 100% because of supply and demand. There's a significant factor. The reason these raw materials went up, the wood to build houses, the copper for the wiring inside the houses, the lithium ion batteries, demand is one part of it. But the other part that caused a significant increase is because the government printed more money. So now since there is double the money out there, well, roughly 25% increase this year, that's why everything has gone up significantly, because the dollar's worth less. Demand on commodities increases and decreases by the supply of them and the demand. But there's an inflationary price that's put in there that's based off of how many dollars are in circulation. So for example, if you peg it to gold, the amount of gold that would trade for a fixed number of orange, say there's this much orange, 100 pieces of gold and 100 pieces of orange in a set period of time, it would always trade for the same amount. But as inflation comes into play, if you're trading dollars for oranges, as time goes on and as they deflate the dollar and it's worth less, you're gonna require more and more and more dollars to buy the same amount of oranges. In this vacuum example, say 100 pieces of gold will buy you 100 pieces of oranges. Consistently, it would be an equivalent price of 100 pieces of gold to 100 pieces of oranges, assuming the production level of oranges and gold is still at the same rate. So there isn't an inflated reason to pay more. It's a supply and demand issue that would change the cost of these items. So to summarize, a large portion of why these commodities are going up in price is because the government keeps on printing more dollars, and now it requires more dollars to buy the same amount of that product. The product didn't go up in price. The dollar became worth less. That is inflation. Do you invest in commodities? So I personally invest in commodities. I buy gold, silver, I own natural gas investments, and I have other that are not particularly commodities per se, but they function very much like a commodity, which is bullets. You can invest in bullets. And real estate. Real estate, again, is not a commodity itself, but it functions very much like a commodity because it's a needed item. It's a base level item. Other things that I've invested in that function like a commodity, which is, for example, I own an accounting firm. We do taxes, bookkeeping, and payroll. Everyone has to do taxes in America if they've ever made money. An insurance agency, and we do home insurance, auto insurance, we do landlord policies, GL policies, we do all types of insurance, and you have to have insurance if you want to drive or if you want to buy a house. So that is a financial commodity in my mind. The next thing would be mortgage company. Most Americans have to get a mortgage when they buy a house. So that's another way that I hedge against inflation through commodities such as financial services commodities. Not standard commodity, but it is, in my mind, functions like a base level item. So when you have these commodities, there's a lot of benefits to them. As inflation happens, as there is scares in the market, when we went through the 2008 crisis, during that time period, gold and silver had a huge rise. And I was buying physical gold and silver. So I owned this physical gold and silver, and I was able to go out and resell it and make money in the spread. To be careful though, you don't want to own paper gold and silver. You don't own the actual asset, and that market is manipulated. So physical price of gold and silver spot is not the same as on the papers market, where you can get a premium in the real world for that. With regards to bullets, if anyone goes to the gun range knows that the price of bullets has gone through the roof. It's very high. Now, if you manage your bullets properly, it has a very long shelf life, and it's a tradable item in certain sectors. If there isn't power, you can trade gold, silver, and bullets for food. So there is intrinsic value to items in the difficulty to create certain items that holds its value, and that's what makes items like bullets, whiskey. Whiskey can also be traded like a commodity. And to some people, whiskey is a commodity. Even though it is not specifically come to the ground, you have to go through a manufacturing process. But whiskey itself holds its value, and it is a tradable item in, again, a scenario where there isn't any power and there isn't any money that you can trade. You can trade whiskey for food. So these items, to me, are these base level, and every single one of them has gone up with inflation. Now with gold and silver, there's a lot of manipulation in that market, so it hasn't seen the true rise that should happen. Silver should be somewhere between $100 to $200 an ounce without the paper manipulation, and gold would probably be somewhere between $18,000 and $30,000 if they had true price discovery without the papers manipulation. And this means on the papers market, they're selling more gold and silver than it's physically available. So because of that, if they say, hey, we have this quantity and they're selling it on the market, they don't actually have that available to give it to you, which causes price discovery, the supply and demand, to be off. But if they actually only sold contracts on the physically available gold that they can actually deliver to you, you would see that the price would be significantly higher based off of this, with true price discovery. Now, you would say, how is this possible? The reality is people don't actually take possession of their silver and gold or oil or whatever they're buying. They're only buying it on paper as an insurance policy or as a profitability. So if the price goes up, they make that profit. They don't actually take it in. So that's where you can see that the system, Wall Street, can manipulate it, because they can manipulate it so you don't get a full gain. And they can also play it where they're selling you the contract. So they make profit on the sale of the contract. If they're on the other end of the deal where they have to pay you if there is a big gain in gold and silver, they lose a lot of money. So it is an unfair bet that they will benefit against their own customers that they're selling something to. So avoid the papers market. You want to own physical assets that is yours and that you can either keep at your home safe or keep with a private company in their system to protect your assets and avoid manipulation.
To add to that, are you saying, when you mentioned the mortgage company you own, an accounting firm, right? Is it just overall your small business can be considered a commodity depending on what your small business is?
So technically speaking, to a economist, they would not say my accounting firm, insurance agency, and mortgage company is a commodity. They wouldn't say that. I am saying, in my opinion, I consider it like a financial commodity because you have to do this in this space. Can there be supply and demand where the economy is bad, so less people can get a mortgage? So now the demand is lower, so there's a change in that price? Yes. But for me, it's a commodity because you cannot function in modern society without a mortgage. You cannot drive a car legally without car insurance. So there's a demand for that is ingrained to our system that makes it function like a commodity. That makes it function to me like a currency because it is paying me in all seasons. For example, another example that I think is basically commodity, but it's a commodity business, which is grocery store. A grocery store, they have very little margins, but in a down market, a grocery store is one of the good businesses to own because people are still buying food. You have to buy food. And the grocery store will function, in my opinion, like a commodity business. It will always generate money. It always has a demand and a need. Very few people can grow their own food. So that is other ways where you can have a similar result than owning a farm. So a personal example of how commodities have benefited me specifically. Back in the day, I've always enjoyed buying silver coins and collecting them. And I would buy them for undervalue, I'll buy them for spot value, and I would collect them. When the 08 crisis happened and the market crashed, it is common for people to run to silver and gold as a protection. When that happened, my real estate fell, but my gold and silver spiked. Now, that spike helped me because now since gold and silver is in high demand, I was able to sell the gold and silver to bring in additional money to help cover my real estate business. So I have multiple businesses and multiple investments. So as one can go up, one might go down. And then as they cross over, I will have an average over time of continual growth. So by diversifying my risk into different investments and different commodities, I can average asset appreciation, I can average P&L, profitability, increased income, or consistency in my income as times have changed. So that is so important because what most people are all in to one thing, Enron. If you guys remember back when Enron, the people that were working for Enron also had all of their stocks in Enron, so they lost their retirement and they lost their income. They had nothing left. They lost everything. With that, all your eggs are in one basket. Now at the same time, Warren Buffett says it's not advisable to have 20 baskets because it's hard to focus on 20 different baskets. If you have about 5, that's probably a good amount of baskets that you can focus on at the same time. So, or at least break them up in such a sense that you can focus in an appropriate amount of time to it. Because there is a thing of over diversification where as you diversify, usually after 5, the return on your diversification drops significantly. And in the real world, I see people that do this, and the amount of fees that they pay, I call it feed out, the amount of fees that they pay to have 5 different investment styles and multiple different options within each investment style, you're paying so much in fees. For example, the amount of cryptocurrency people are buying today. Some people are buying $100 or $1,000 at a time. Well, you're paying $4 per transaction when you are buying $100 worth. And if you're selling $100 worth, you're paying another $4. You paid 8% just for that, ignoring inflation and anything else. So there is an amount of over diversification that will hurt you. So another benefit is my accounting firm was still generating money during the 08 crisis, when we went through the eviction problems and having to bring in money when I was basically breaking even in the rental business for 3 years. 3 years of breaking even, working for free, keep it going, because obviously it was one of the worst housing markets in history. Thank God, because I had the better loans, I didn't have any toxic loans, I was able to keep my debt the same and focus on just improving the property and bringing in good tenants. So during that time period, it was rough. My profit basically disappeared. So I was breaking even, which I was fine with, but I needed to make money. And how did I bring in money? My accounting firm was still bringing me in money because people had to do their taxes. So that benefit is beyond dollars, right? It's also the stress factor. It's the comfort level. It is having the peace of mind that your family's still going to be taken care of if things go sideways. So commodities can offer great benefits when you consider the full picture, not just what's my return. So where can you purchase most commodities? A lot of people are purchasing their commodities in the papers market, right? They don't actually own it. It's not truly to a tangible good, right? And a lot of times they won't deliver it. So it's preferable that you buy the commodities from, say, silver, gold, from actual dealers where you're gonna take possession. You can actually buy some of these silver coins directly from the US Mint. Might be difficult to get your hands on some, so a lot of times you have to go to a third party to receive them. You can buy, again, bullets. Bullets can function like a commodity. So you can buy them in a big quantity, keep them, and then in 5 and 10 years, the price historically has gone up significantly for bullets. I mean, some bullets now have gone to $1 per bullet, where you used to be able to get them for 10 cents a bullet. That is insane. Like, there's very few things that you have 1,000% increase, right? But again, I bought a box of bullets. I was thinking, all right, I'm gonna go shooting one day. Instead of buying one little box at a time, let me buy a whole case, right? Got a whole case of them. The return on that case is so high, right? The problem that I'm running into is I'm like, dang, each bullet's so expensive. Even though I bought it cheaper, I have to spend a lot of money for shooting. So should I shoot them and enjoy it? Or should I sell it and reap the benefits? So thankfully, I don't really need the money right now. But if something happened and I needed the money, I could sell the bullets. And because there's people locally who will go buy them from you. So go to an actual location where you can buy physical product, right? You can buy them off eBay, silver coins. You can get silver coins, gold coins off eBay. Be careful. There's a massive amount of fake ones out there. So it might be better that you buy it from a local dealer. Now, if you see online the price spot is $20, a lot of times there'll be $1 to $3 over that to buy it in the true market. So that's another example of how the papers market doesn't match what the true market price is. Real estate, rental property real estate, where people are living in it. Mobile home parks is being considered in my opinion, like a commodity. It is the base level living. I mean, there's really not, from the affordability level, there is some very high-end mobile home parks, right? On the water, gorgeous, very impressive mobile home parks. But in most people, they understand mobile home parks as this is a low-priced option for living. You can get a place for $500 to $1,000 a month. And this is, a very conservative way of living. So this is a commodity in the living space. So you can own a mobile home park. You can own a syndication into a mobile home park. You can own workforce housing in a high demand job market. So these are ways for you to be able to also hedge yourself against inflation into these type of off commodities. Again, they're not official commodities, but in my mind, they function like a commodity. It's a necessity. So own the physical item is what I'm going for, or own your position in a syndication that owns the physical item. One example I want to give, the last example I'll give you is like, say, cryptocurrency, Bitcoin. If you own your Bitcoin in PayPal or Cash App, you do not own it. It is not yours. So you should not buy it from those sources. You should own it on a platform that you own the coin. It's your coin. So we're actually coming up with our own app where you own your coin. It's not a guarantee of a coin that someone else is holding that very quickly can change to a derivative of and a paper version of that follows that price. That's not what you want, because then if you continue that path, what will happen is they will make all these other assets undervalued like they're doing that to silver and gold. So own it physically.
Can you just explain, like, you keep saying paper market, is that like literally a market?
So Wall Street, all right? So there's Wall Street and there's Main Street. I believe people need to buy from Main Street, right? You can do syndications where you're partnering with people and you own a share of the real estate or the gold or the natural gas well or the cryptocurrency, but you own a portion of it. You are part of the owners. You're not dealing with Wall Street. What Wall Street will do is they'll sell you a paper version of it. So you don't really own that asset. You own an interest in the movement of that asset. So we'll say that, we're gonna say tea leaves, right? We're gonna say these are tea leaves. And
Tea leaves.
tea leaves, like you make tea bags out of them so you can drink tea. So around the world, tea is a big commodity. I mean, the war with England was over tea prices, the tea tax. So again, there's parts of the world, and my wife that cannot live without her tea. So these are tea leaves, and we create a syndication, and you invest with me, and we own this tea leaf manufacturing company, or we own this farm that makes tea leaves, and so on. So you own the interest. You're the owner of that interest, right? In Wall Street, if you're investing in tea leaves, what they'll do is they'll sell you a contract on the price of leaves and the movement, and if you in a year sell it, right, a futures contract, or if you sell it in the future, you're gonna either make a profit or lose money based off of the paper, not actual interest. So it is not, it's called a derivative, right? It's a derivative of the actual item. Now it's not the derivatives market, that's different. But the point is, they will manipulate it at times where the true price discovery doesn't happen, especially if they're gonna lose. So for example, that happened with the Big Short, where they were shorting the housing market and they wouldn't accept that they lost, and they were trying to hold off before paying, right? So Michael Burry was stretching it out so he can get paid off on his contract on the papers market, because the true market showed housing prices crashing. But the agreement that he had was, if housing prices crash, if this asset crashes, you have to pay me the difference in the loss. So he wins if the price goes down. Well, what they did is they never pegged the asset down. The housing market crashed, but they said, nope, the housing prices are still worth this much. But in the open market, they're selling down here. And because they wouldn't accept it, and these Wall Street companies are so large that they wouldn't accept it, so he kept on having to pay to extend his contract, and they were basically trying to wait him out so he could go bankrupt before making his profit. And then they were trying to renegotiate with him to take maybe less of a profit. They didn't actually finally pay him out until they had other people dumped it on other people to take the loss, and they had government step in to help shore them up. And then they finally, settled and gave him some of the profits. So my point of this story is this, is that when you're dealing in the papers market and you're dealing with Wall Street, they can manipulate the true price of something, fabricate how much actually is out there to keep it from the true market price. So even though it's a lot easier to just buy and sell on there, it is also a lot easier to be manipulated and to keep you from making your true profit on the deal. So in closing, commodities are a great hedge against inflation. When you're buying this physical asset, people need to own it, people need to eat it, people need to use it. So when they are working with this item that's necessary to our society, as they print more dollars, people are gonna have more dollars than the stuff that they need. They have to trade more dollars for those items. Commodities are a great hedge against inflation.